All right, let's talk about car insurance. It's one of those bills most of us just pay every month without really thinking about it. But be honest, if I asked you to explain exactly what you're covered for, could you do it? Yeah, if you're a little fuzzy on the details, trust me, you are not alone. So let's dive in and actually make sense of it all.
Yeah, look at that number. Over $2,000. For a lot of Americans, that's what we're spending on car insurance every single year. I mean, that's a huge expense, right? It's right up there with your utilities, your groceries, and for a bill that big, you really deserve to know what you're getting for your money. And that really is the big question, isn't it? Are you overpaying? Or maybe even worse, are you underprotected? So here's the goal for this explainer. We're going to pull back the curtain so you can confidently answer those questions and finally feel like you're in control of your policy. Okay, so every car insurance policy is really just built from a menu of different coverages. Think of them like building blocks. So let's break down the 6 core coverages, the most important ones, so you know exactly what each one does.
First up, we've got liability. This is the absolute foundation of any policy. I mean, it's the part that's legally required in pretty much every state. Now, the most important thing to get here is that liability covers the other person's damages when an accident is your fault. It's not for you, it's for them. And it's split into 2 parts. You've got bodily injury, which pays for their medical bills, and property damage, which pays to fix their car or, their fence, whatever you hit. Basically, it protects other people from you, which in turn protects you from getting sued.
Okay, let's talk numbers, because this is where it gets real. Your state might only require you to have the bare minimum, right? Maybe something like $25,000 for bodily injury. But here's the thing. A single serious accident can cost way, way more than that. I mean, just one broken leg can easily cost over 30 grand in medical bills. So if your limit is only 25,000, guess who's on the hook for that extra 5 grand? You are. They can come after you for it. And that is exactly why pretty much every expert will tell you to get much, much higher limits than whatever your state minimum is. Okay, so we've established that liability covers the other guy. But what about your car? Who pays for that? Well, that's where collision and comprehensive come in. Collision is pretty straightforward. It pays to fix your car after a crash, whether you hit another car or you hit a guardrail. Comprehensive, or comp as it's often called, covers damage to your car from pretty much everything else. We're talking theft, fire, a crazy hailstorm, or yeah, even hitting a deer. The easiest way to remember it, collision is for crashing, comprehensive is for, well, everything else.
Now, whenever you use collision or comp, you're going to run into something called a deductible. All this is it's your share of the bill. It's the amount you have to pay out of your own pocket before your insurance company steps in and pays the rest. A common choice is like $500 or $1,000. And here is the key trade-off you need to remember. If you choose a higher deductible, your monthly bill, your premium, is usually going to be lower. It's a balance. So, what if someone else hits you and they don't have insurance? You might think, oh, that's probably pretty rare. But it's really not. Get this, about 1 out of every 8 drivers on the road right now has no insurance at all. Just think about that. Every time you drive to work or the store, you are sharing the road with people who have absolutely no way to pay for the damage if they crash into you. That is a massive risk.
And this is your shield against that risk. It's called uninsured and underinsured motorist coverage. The uninsured part is simple. It pays for your car repairs and your medical bills if the person who hits you has 0 insurance. The underinsured part is for when they have insurance, but just the state minimum, and it's not nearly enough to cover all your hospital bills. Honestly, a lot of experts will tell you this is one of the single most important coverages you can possibly buy. All right, next up, we have something called MedPay, or in some states it's called Personal Injury Protection, or PIP. This one's designed to pay medical bills and fast. The key here is that it covers medical expenses for you and your passengers, and it does it regardless of who was at fault for the accident. In what are called no-fault states, this is often required, and it means your own insurance pays for your injuries first, which just speeds everything up and can even help with stuff like lost wages. Okay, last one here. Let's talk about gap insurance. Now listen up, because this one is super important if you have a loan or a lease on your car. We all know that cars lose value the second you drive them off the lot, right? Well, gap insurance is designed to cover the gap between what you still owe the bank on your loan and what the car is actually worth if it gets totaled in a wreck. Here's a perfect example. Let's say you still owe $25,000 on your car loan, but because of depreciation, the car is only worth $20,000.
If it gets totaled, your regular insurance is only going to give you that 20 grand. So without gap insurance, you'd still be on the hook. You'd have to write a check to the bank for $5,000 for a car that doesn't even exist anymore. That's what gap insurance does. It pays that 5 grand for you.
Okay, so now we know what all the pieces of the puzzle are, but how do insurance companies decide what to actually charge you for all this? Well, it's definitely not a random number. It's actually a really complex calculation of your personal risk, and it's based on a handful of key things about you.
So here are the main ingredients that go into your price. Of course, you've got the obvious stuff, your age and your driving record. But some of these might actually surprise you. In most states, your credit score plays a huge role. Yeah? Really? Insurers have found a link between how you handle your money and how you drive. Your location, we're talking right down to your zip code, can also make a massive difference. And of course, what kind of car you drive and how much you drive it every year. It all gets factored into the mix.
Okay, now for the part everybody wants to hear. How do you actually save money? The good news is you're not just stuck with whatever price they quote you. You actually have a surprising amount of control. So let's walk through 5 proven ways you can lower that bill.
All right, number 1, and this is the biggest one. Shop around. Don't just get one quote, get quotes from at least 4 or 5 different companies. Number 2, think about raising your deductible, but only if you have enough in savings to cover it in an emergency. 3, you have to ask about discounts. Don't assume they'll just give them to you. Ask for a list of every single one. 4, work on improving your credit score. It can make a huge difference over time. And finally, number 5, don't just set it and forget it. Look at your policy at least once a year to make sure it still fits your life.
All right, we've covered the smart things to do. Now let's talk about what not to do. Let's go over 3 really common and really costly mistakes that can leave you in a terrible financial spot. And trust me, avoiding these is just as important as finding all those discounts.
Mistake number 1, thinking that the state minimum coverage is enough. It is not. Seriously, state minimums are dangerously low. If you cause a bad accident and the medical bills are way higher than your tiny limit, the other person's lawyer can and will come after you personally. We're talking getting your wages garnished or even your assets seized to pay the bill. It's just not worth the risk.
Okay, mistake number 2 is a weird one. Being too loyal to your insurance company. I know, it sounds crazy, right? But many insurers have this thing where they slowly raise your rates over time, year after year, basically betting that you won't bother to shop around. It's sometimes called a loyalty tax. And the data is clear. People who actually compare quotes every year or two can save, on average, around $700 a year. So loyalty doesn't always pay.
And mistake number 3, not telling your insurance company when your life changes. Think about it. Did you get married? Did you move to a new zip code with less crime? Did you start working from home and you're barely driving anymore? All of those things can lower your rate. But your insurance company isn't psychic. They're not going to know unless you pick up the phone and tell them. You got to be proactive.
So what's the bottom line here? It's pretty simple, actually. Knowledge really is power. When you actually understand what all these different coverages do, you get to make the smart decisions. You can make sure you're properly protected without getting tricked into paying for stuff you just don't need.
And of course, I got to put this important disclaimer in here. Everything we've talked about is for educational purposes. Insurance is really complex. It changes from state to state, so please talk to a licensed agent or professional to get advice that's actually tailored for your specific situation. I really hope this breakdown helped make car insurance feel a little less like a mystery. If it did, and if you like this kind of simple, straightforward way of explaining finance, do me a favor and hit that subscribe button. We've got a lot more explainers just like this one coming your way. Thanks for watching.